Hi, Dan Kerr's DK Analytics. It is November 20th, 2016. Thanks a lot for tuning in. We wanted to give you a video update on goings on, and boy, there has been a lot since the election, the U.S. election, where Donald Trump won the Electoral College victory he needed to become president-elect. It surprised a heck of a lot of people. The majority thought that Hillary was a shoo-in, the capital markets did, and obviously Hillary Clinton had huge backing of a very one-sided coverage by the mainstream media. Obviously had Wall Street and hedge funds on her side, and frankly what we call globalists, people that are interested in eviscerating the national sovereignty of countries to higher levels of authority, quote unquote, and multinational corporations. This is a trend that a lot of the world's residents, that is, in Western republics, are getting tired of. What's happened in the United States, we could call it Brexit on a U.S. scale, and an even more resounding victory because Trump can make policy with this or go a long way towards trying to resurrect the loss of constitutionalism during this his administration. Now, let's talk a moment about the win. All of you, or most of you, know that the U.S. has systemic voter fraud issues. This isn't just conspiracy theory. It's I'm going to call it conspiracy fact. Nobody other than, or none other than the Pew Research, quite a neutral observer / think tank, has found very large examples of voter fraud, double or triple voting, dead people voting. We have many states that don't require identification, and illegal aliens and others can vote or vote twice, Americans that is. So it's quite a sad state of affairs, and doesn't speak volumes about a serious nation. This is banana republic stuff, but hopefully, well, the important thing is that despite this, Trump won the election. And I think that the heartland of America, the red states that make things, that have been increasingly disenfranchised, that have lost full-time jobs, that can't afford to pay health care, that see, in effect, their property rights, their tax dollars being, excuse me, misappropriated. By the way, a little confession. I've run into a cold all of a sudden. I bravely or stupidly told my mother and daughter just yesterday that I don't get colds. Everybody else does. So pardon me if I sneeze or cough here very briefly during this video. That is the result. I grew up Catholic, so there you go. Back to the election and the impact. The GOP, the grand old party, which isn't so grand anymore. I became an independent in 1997 because the Democrats and Republicans both smeared the Constitution, the representative government. But what's important is that if Donald Trump is really so inclined, big question marks about that, also given his past. He's a member of the establishment class, all right? He's also a crony in that he has enabled himself of tax law advantages and other things to, in essence, stiff creditors. So and he's very dependent. His real estate empire is very dependent upon a money printing central bank. That is a bank that creates monetary inflation. And that makes him very doubtful that he will have true parallel interests, even if he puts all his massive real estate holdings into a blind trust, with a return to sound money. One of the things that so ails our system, and one of the principal earmarks or defining features of our, what I call, public policy stew, our toxic public policy stew. I go through this often with my joint venture partner here in Southwest Florida, that if public policy is bad or good, it leaves quantitative traces. it leaves quantitative traces such as the vigor of real GDP growth, the vigor of productivity, um, the vigor of average family income, the fact that there isn't a wide or gaping and growing gap between Wall Street and Main Street. In other words, that it's meritocracy instead of cronyism. That allows you to climb the ladder of success, and the government gets out of the way instead of unnecessarily in the way, which is obviously what we're lacking. Donald Trump's ascendancy to the presidency, president-elect status, caught a lot of people by surprise. Here is something fun, if you'll allow me a slight detour. I bet two people over the last year, year and a half that Donald Trump would win. I made that bet because I thought that a lot of heartland Americans thought they were losing their country, losing the country's borders, being overwhelmed by a wave of illegal immigrants from the third world, and that this is not how you can keep a republic going that has a welfare state and is already running huge deficits of all kinds. And frankly, this is the same thing that Europe is experiencing. This isn't discriminatory. It's just that republics, countries are run for their citizens, not for the rest of the world. That's the same way Mexico or Saudi Arabia or India treats people that want to come in. And why on God's green earth should Western republics / democracies be any different? So for me, winning that bet was based on that assumption. But as we know, or as I just said, public policy, and in our case, a toxic public policy stew, which eviscerates the rule of law, property rights, sound money, has been long ongoing and is just getting worse and worse. And this is something which continues to leave its visitor card in our GDP, our income, our average family income growth, our productivity, our debt, because we can create the money to pay to, in essence, run a public policy that throws massive sand in the gears of free market capitalism. So that is the rub, and it's coming home to roost in an economy that is ever more debt-laced, that has lower productivity, that is suffocating from a morass of regulatory insanity. Over 5,000 new regulations issued a year, from huge tax complexity, and also way too high tax rates compared to the other leading nations at a corporate level. So Donald Trump, sometimes it takes a thief to catch a thief. And Donald Trump has a historic opportunity, and he's shown that with his vice presidential pick, Pence, his pick for Attorney General, Jeff Sessions, an incredibly honest constitutional man with huge integrity, despite how the leftist media is going to paste him. He and some other people he's electing are good signs that Donald is a reformed sinner, quote unquote. And when I say that, I'm talking about Donald Trump's own pummeling of the Fifth Amendment, eminent domain abuse, where the Supreme Court came out in London versus, or Kalo versus New London, in essence allowed governments to usurp property that had been acquired by private citizen if there was a big enough developer in town. Hello, Donald. And but back onto the main road here. What Donald Trump has, given the majority in both chambers of Congress and broad Republican control of states, is a unique opportunity, if he chooses to make it so, if he chooses to fight the very entrenched bureaucracy that has in essence been making the laws, otherwise known as regulations, which isn't representative government, also not rule of law based. If he decides to really make an effort at reforming this and focus on this, instead of touting trade war stories or Hooverism Revisited, where if all of a sudden he decides to call China a currency manipulator, Well, then the Chinese could easily go to Europe and buy Airbuses instead of Boeings, and you get into a tit-for-tat trade war. Very, very worrisome, and hopefully he will tone that down and tone up his promises to bring us back to the rule of law and sounder property right protections, because those things, if he does them, will go a long way to setting a brighter future for the free market of America, which has been so suffering thanks to central bank policy, inability of getting credit. The big corporations can buy back their own stocks, but small companies can't get financing. The economy is dead in the water because big companies haven't been reinvesting in the United States. They've gone overseas. Domestically, they've spent more money on stock buybacks and dividend outlays from their cash than they have in capex and R&D. So they're not reinvesting, and large part of that is because America, frankly, isn't open for business, quote unquote, at least to a lesser degree than the other countries, and that's why corporations have been fleeing U.S. shores and looking for greater growth opportunities. Not only are there greater growth opportunities, but they're much more friendly regimes or governments in terms of how capital is treated, how capital is taxed, and frankly, significantly more regulatory sanity than the insanity of 5,000 new federal government regulations unconstitutionally thrown into the mix year after year, where Americans and American companies walk on eggshells, never knowing when they're going to be effectively held at gunpoint or have their property held up in court. So these are things that Donald Trump has a unique opportunity to attempt to correct. Thanks also to the fact that it only takes a simple majority in Congress after what happened with Harry Reid's playing of old traditions in the Senate. They only need, that is, Congress needs a 51 majority vote in order to pass the cabinet appointments of Donald Trump. So he has free reign here, and theoretically he should have a Congress that is behind him. There we know that the rhinos, the establishment Republicans that haven't used their majority since 2014 to effectively rein in an imperialist president, to check his spending because they have power of the purse, to take Obamacare, which only the legislative branch should be able to bring into existence, which the Obama administration changed 20 different times unconstitutionally, to take it apart, reform it, to have power of the purse and just refuse to fund out of growth spending by the U.S. government as dictated, quote unquote, by an imperialist president. So we have a big question mark here of not only where is Donald Trump's heart really? Is he really a reformed sinner, quote unquote? He clearly loves America. That is entirely different from Hillary. He's not pointing to deplorables in the heartland, and that's a good thing. But whether he can make constructive policy with a mandate that he has depends upon where his heart is, whether he is honest and he has integrity, and he doesn't just do this, wear it on his shirt sleeve, that he wants to get to know and then improve the rule of law, bring us back to our Constitution. But at least we have a chance, right? That's the big plus here. That's the big plus. And we wouldn't have otherwise. And importantly, as all of us know, we have a chance of appointing people to the Supreme Court and to other courts that are going to be constitutionalists rather than leftist politicians that want to override what the Constitution states. And the Constitution is a document which actually is there to amplify and maximize the liberty and responsibility of individuals and to minimize that of the state. It isn't there to protect the government. It's there to protect the true sovereigns, the people. And obviously this hasn't been happening, and decreasingly so. Whether it's lack of separation of powers in D.C., that is, we have a judicial oligarchy, we have an imperial president, and we have a do-nothing Congress which should grow a set, if you'll pardon my expression, and exercise the expansive powers that it has, including not only the key power of the purse, but the ability to rejigger judicial system below the Supreme Court level if it gets out of control. So they have an opportunity. If we have Donald Trump riding high on his horse and has Constitution in his heart, then he will have to make sure that the rhinos, the Republican and name only people in Congress, which are the cronies, which are the ones that have eviscerated separation of powers, the people that are all too comfortable with an increasingly crony / tyrannical status quo, i.e. not in being representatives in a republic, that remains to be seen whether he can also get them aligned. But again, we have a hope. And this is huge. And if this happens down the road, we're going to have a substantially better country with better opportunities, more pronounced wealth creation by the private sector based on meritocracy, not on cronyism and who you know in the government. So instead of propagating in a one-sided trajectory, the welfare of Wall Street, of K Street, the corridors of power in D.C., the United States of Goldman Sachs, if you will, to overstate it a little bit, we're going to have the engine that produces the wealth and the tax receipts to really get back into a less deficit encumbered growth trajectory featuring more fairness and more income prospects and better property right protections. One last thing on property right protections and rule of law. These are not esoteric concepts. This is something that I talk about with my colleague, my joint venture partner. And as I've mentioned before, if we have rule of law, everybody is subject to the same law, including the mighty. You cannot have an unindicted felon running for president. You cannot have banks, big bank chieftains, manipulate the heck out of markets from gold to LIBOR to currency markets and not do any time, whereas an average American would have been thrown behind bars for God knows how long. So you also cannot have a Congress that exempts itself from Obamacare using ridiculous small employer status of less than 50 people, yet impose it willy-nilly on the rest of America, and people are having a hard time getting any kind of coverage and frankly paying for health care. That's why most people are opting out wherever possible. As far as property rights are concerned, and these two are tied at the hip, what we've had are things like TARP, where in effect Americans have subsidized and made whole the derivative bets gone awry by the bankers. So they are subsidizing millions of dollars in salary and bonuses and Lamborghinis and whatnot. And this is nothing other than to transfer of property rights from the public to the privileged class. That's not what this country is supposed to be about. The same holds true for Obamacare, from takers to makers. And frankly, the same holds true for this massive welfare subsidy that is furnished and healthcare benefits that the illegal alien immigrants have in this country. I know it. I see it around me. This isn't just hearsay. So if we could get those things to head in the opposite direction, think of the potential this brings. But now let's step back finally and take a look at valuations in both stocks and bonds. Let's juxtapose valuations in stocks and bonds as created by central banks with either zero or negative interest rate policy forcing people into stocks because there are no yields anymore. Pension funds are going broke. We have the demographics aging problem superimposed on that, but we have yield starvation, yield deprivation. So there's the societal cohesion also, as people realize they're not going to have the pension funds they thought they had coming if they're defined plans. And this isn't just the United States. This is also in Switzerland, very rich country, and other places where this is a big issue. But what's going to happen is that with our current asset prices. This grotesque manipulation, thanks to central bank monetary policy, whether it's on the short end with zero or negative interest rates in Europe and Japan, whether it's the long end with massive QE or bond buying, mostly government bond buying, to sustain deficitary operations of governments, such as the United States, where the tax revenue is up 84% per annum from the beginning of the Obama administration, yet debt is up by over 9 trillion. So it isn't government not having enough growth in receipts. In fact, it's got the receipts growth thanks to increasingly high rates of taxation, not very good for capital formation, right? But what we see is a system built upon an edifice of paper money divorced from the disciplines of above ground silver and gold. And that is what has financed the entire toxic public policy stew, which the central banks are in essence the enablers of, and they are highly political. And those central banks have not only caused stock prices to go into the stratosphere, totally divorced from any real returns, from any compensation for risk or inflation, but they've done even more damage in terms of yields that people get on so-called safe bonds, government bonds, 10-year bonds across the world, whether it's Japan and Europe that are flirting with negative interest rates or in them, where people the savers buy them and actually have to pay for the privilege of lending their money. It's even gone to European corporates. But what we have is this huge disconnect between valuations and bonds and stocks priced into the stratosphere, right? No free market discovery. If private investors sat down, what do? They forestall consumption and save, not only because they have to, but they expect to have more capital, more money as a result of waiting. That is, they want a real yield, and they want inflation, and they want solvency protection or protection against insolvency. Whether neither stocks nor bonds offer any semblance of good return hopes going forward, regardless of whether Donald Trump is able to make it into the White House, and regardless of whether he is able to institute a shift in the aircraft carriers' move away from the rule of law and property rights, and the move away from sound money to anything but, which, as I said, is very doubtful given where his interests are and how he made all his money. But let's say he's able to do that down the road. Nobody is going to change the fact that we are, for all intents and purposes, in the teeth of an increasingly stout recession, no matter how much the government statisticians manipulate the real GDP growth rate. If you look at labor force participation rates, if you look at over 94 million Americans out of the workforce, if you look at 45 million Americans on food stamps, if you take a look at industrial activity, which has been down for over a year running, typically always associated with a recession, wherever you look in the real world, we are in a recession, yet prices of things such as rents, such as tuition, such as healthcare, where you not only have exploding premiums, but you have massively increasing co-pays and self-pays. We have an economy that the real growth rate is probably negative, yet for the average person's expenditures, what really makes up his consumption basket, it isn't an iPhone or a laptop. It's what he has to pay every month in healthcare and rent and tuition. Those are the things that dominate it. And by golly, those are 3 or 4 times as high as what the government statisticians use to tell us what a real GDP growth rate is, which is substantially lower. Tied into that low real GDP growth rate, which if you use a real inflation number, never exited recession, we find the following. And this should come as no surprise, and my partner and I have been presenting this here locally in Southwest Florida. If you adjust corporate sales, the top line, right, for inflation and stock buybacks, assume they didn't buy back any stocks, would you believe that corporate sales, this is according to John Williams of Shadow Stats, a guy, an honest Abe that's got a doctorate in economics from Dartmouth. It's been doing this out of San Francisco for, I think, decades. The corporate real sales with share buybacks dialed back in are down some 30% from the first quarter of '08. Now, doesn't this dovetail nicely with an economy that actually never got back into real GDP growth if you use an accurate inflation estimate, not estimate, an accurate inflation number. In other words, more like 8 or 9% instead of 1 or 2%. So now, take this a step further. We're trading at 25 times trailing 12-month earnings, with earnings already backpedaling, earnings per share. Standard & Poor's down about 15% from the 14 high. Now, what happens if we get into a recession? Well, a recession is what, like minus 1% real GDP growth? Let's use the government fudged number for a second. Well, corporations whose top line is already under pressure easily suffer in a typical run-of-the-mill recession with maybe minus 1.5% real GDP growth rate, government stats. They easily suffer an earnings erosion of 40, 50, 60%. Now, let's take our 25 multiple. Let's say we just have an average haircut in earnings of 40, 50%. Why then stocks would be, say we earnings slide by 50%, which this time around, given that we doubled down on all the insanity that brought us the '08 problem in the first place, less rule of law, less out property rights, more regulations, more debt, again, financed because the central banks can print our money to sustain a toxic public policy stew, and 400 trillion plus of derivative exposure by our leading money center banks that are extremely sensitive to higher interest rates if we have accounting, right? So consider this. If stocks all of a sudden had earnings per share, which are financially engineered, they're not top-line growth, we've got this huge debt overhang, we've got these other issues I mentioned, let's just say they do go down by only 50%, only in quotation marks. The stock market would be at 50, but in a world where we have increasing instability instead of growing stability, investors might, guess what, determine that they're not ready to pay 25 times earnings. Historically, we have a P of about 15. Historically, we don't have reversion to the mean, meaning stocks go from boom to bust. They go from 25 to under 10. That's what history has showed us. And if that happened this time around, we could see carnage in the stock market where people have losses well in excess of 50% within a relatively short period of time, within half a year, within a year. Now, oftentimes people will come back and they say, and rightfully so, well, then the Fed is going to do QE4 and they're going to print till the cows come home and is going to put anything that anyone's done to shame. I agree. But first, the stock market has to collapse. All right. When in '08 the stock market collapsed, it took the Fed, which at that time had short interest rates at 5%, they had to drop them to zero. We're already at zero. We can't go much lower, one would think. It took them round after round of bond buying to push down the Treasury to convince stock market participants to take a punt to invest because the Fed had their back. This time around, Economics 101 suggests stocks are easily at the index level, S&P 500, 50%, if not 70% overvalued if we're in the brink or in the teeth of an increasingly stout recession and earnings drop 50, 60%, right? This time around, we not only have the earnings compression, that is very likely, but people might decide to seek higher risk premiums, higher premiums for our more leveraged balance sheet in the United States, around the world, 300% of GDP. They also might seek protection against a lot of turmoil, political and economic. So what happens if they sell stocks beyond a 25 multiple on the way down? Again, we could be down 70, 75% before the Fed, and that, ladies and gentlemen, when that happens, like in '08, that will bring with it the entrance point for people that can then know or assume with good thinking that the Fed will do anything and everything to push the stock market back up. Not only that, but let's let the laws of math work for us. If stocks went just down 50%, and instead of having a 2% yield, we all of a sudden had a 4% yield. Let's say you're lucky enough, smart enough to sell. Let's say you're going to pass on a cocktail party chatter of how you made more money on the back of Trump euphoria or Trump mania or whatever the flavor of the day is. And the laws of gravity, the laws of economics, the laws of earnings compression works, and it will, because the business cycle has not been rendered obsolete, and we've done everything to make sure that it hasn't. We've done everything wrong since 08, double down on what we did wrong before. So if you now just think of it this way, you're smart enough to sell at 100, say you use 100 because it's a round number, you take the proceeds from that sale, and you're smart enough to repurchase at 50. I'm going to say 100 because you could have a basket of stocks, whether it's 10,000, 100,000, but let's again use the percentage. If I use 100, sell at 100, say today's S&P, right, close to 2,200, 25 times plus earnings, and then buy it back at half. What do I get? Well, I can buy 2 times as many stocks, right? And the dividend yield per stock is going to double. So I go from a 2% dividend today, I call it a 2 for plus in our presentation, to an 8% dividend yield if I can repurchase at a much more sane capitalization. And it might get a lot better than that, right? But think of the return math of sidestepping this. Consider these asset bubbles, gifts from the heavens, from money printing central banks that are very political, that have an agenda to sustain asset values and to reward debtors and to punish savers, right? Consider this gift, take it, and position yourself for substantially better dividend yields. 2% could turn into 8%, and also lower risk because bad news is increasingly in the price, and much better return prospects because returns depend upon not overpaying for an earning stream in the first place. Now, the same holds true, last but not least, for, you guessed it, bonds. We've been in a 35-year bull market in bonds. Bonds and stocks are tied at the hip. They're both discounted back at the prevailing 10-year Treasury rate, the benchmark rate of supposed zero risk return. I'd argue with that, but let's leave it as it is. If Treasury yields head north, Treasury prices head south. We went from 1.5% about a month or two ago all the way up to 2.3%. People who think bonds just go up and up and the yield goes down and down are wrong. Bonds have lost about 8% of their value, and we're way below at 2.3% or so an average yield for investment grade 10-year government bonds wherever in the West, right? If we move back to, say, an average return from 10-year government bonds, we'd be looking at 4.5%. Now think of this. We need to go from 2.5% in the United States to 4.5%. But as I said before, we don't have reversion to the mean. We don't go back to an average yield or an average PE. We go from boom, way below average yield or above average PE in exactly the opposite direction. So bonds, which during Volcker Tough Love in 80-81 had a 15% yield, when stocks, by the way, had single-digit premiums. Those two go in opposite directions, right? Because it's the discount rate on the 10-year Treasury that determines to a wide degree PEs on stocks. And when you have very high bond yields, you also have what? Very high inflation rates. Today, we've got just the opposite. We've got extremely low bond yields and low published inflation rates, which only have but one way over time to go, given the monetary policy that's on offer around the world. We have never, ever in the history of mankind had all central banks of the world detethered, delinked from the disciplines of above ground gold and silver stocks. In other words, they can print as they wish. We're what, 45 years into a post-dollar standard, gold dollar standard, Bretton Woods, and this has never happened. And the average life of paper money, divorced from the discipline of above ground gold and silver stocks, is only some 27 years. So we're very long in the tooth there. And back to our yields, how high could yields go on 10-year bonds? Well, they could go a heck of a lot higher, because not only do we typically have reversion beyond the mean, but importantly, our balance sheet, America's balance sheet, the world's balance sheet, America's balance sheet currently is encumbered by $44 trillion in debt. If you take a look at the consumer, the corporate, and the government level, we have tremendous solvency risks, do we not? And by the way, as one slight detour, if you'll allow, the very attributes of Trump's fiscal stimulus, whether it's infrastructure spending way up there, we don't need more boondoggles, more crony boondoggles, right? Look at what happened under Obamacare. The infrastructure is worse today than when he did his $830 billion shovel ready, according to American Society of Engineers. But Donald Trump wants to, and this is so disturbing, push the size of the federal government, the say of the federal government, which is all out of contortion relative to its constitutional limits, even further, and do fiscal spending. Let's say he does this fiscal spending and he juices or gooses government spending. We run into a recession. There are real deficits are above $1 trillion a year right now if you look at the increase in debt. And then what happens? We could have interest rates really rise. And if you take $44 trillion of non-bank, non-financial debt in the country, and you attach a 1% higher interest rate to them, by golly, just the interest expense of the country as a whole will go up by $440 billion a year. So that's going to provide very stout headwind to any fiscal stimulus, because we just don't have the balance sheet left to do it, right? But if bonds are looking at this, and we're having this sharp uptick in yields, almost 1 percentage point within a month or two, treasuries are down 7-8%. But even if this doesn't happen and Trump doesn't go that route, we are, for all intensive purposes, insolvent, right? The only way we can pay people back is to print. And that isn't just America, that's virtually the entire world. So bond yields, if the bond vigilantes come back and they trump central banks, the investable assets of the world, mostly bonds, 3/4 bonds, 1/4 stocks, are roughly $300 trillion. Now, central banks hoover up $2 to $4 billion a year. But if investors really start getting worried about this runaway freight train into either insolvency or stout inflation, because that's what the central banks want, and that's what they've done with their balance sheets. They've put the seeds in the ground to have a stout increase in money supply. And the transmission mechanism is people deciding they want to spend their money more quickly, put it into real assets before it loses value. There's signs that this transmission mechanism is starting to happen. We have the money multiplier in the United States going up about 23% over the last year. Maybe that's a preview of coming attractions. But for the bond vigilantes, they are looking at holding treasuries yielding 2.3%. and thinking to themselves, we're not getting a real yield, inflation, real world inflation, 7 or 8%. The central bank's balance sheet is fivefold of what it was, and at some point it's going to impact money supply and bring us monetary inflation. That's really what inflation is. And we've got insolvency risk in that if they don't print, a lot of enterprises are going to go bankrupt. And since everyone is tied into the 10-year treasury, where it goes has big impact. As an investor in treasury bonds at these interest rates, I mean, you're getting a junk bond for all intensive purposes that has a printing press attached to it. And again, this isn't just United States, it's most all governments with very few exceptions, So you're going to take money off the table if a route develops and people get convinced the bull market is over, the central banks can no longer buy enough bonds to manipulate the stuffing out of yields, then look out below. We could see government bonds not only yielding 4.5%, but given the stout erosion of quality of the balance sheet, much bigger solvency risks around the world, much bigger monetary inflation risks, thanks to the same central bankers that brought us these solvency risks in the first place, by buying all this government debt, which otherwise the government could have never afforded. We also stand to have much better purchasing opportunities in bonds down the road. And I suggest that people actively consider culling, reducing exposure in overvalued stocks and bonds, putting money into cash, not just any kind of cash, not cash in banks that can be bailed in and you can support the derivative bets gone awry of the big wig bankers. Talk about property rights usurpation, right? And not necessarily money markets that are tied in commercial paper and also have substantial counterparty risks embedded in them. But purchase treasury bills. The United States government can print the money and it will not endanger this market in any way, because it would endanger its ability to continue to finance itself both internally and abroad to the tune of about $500 billion. So look for a refuge in safe cash. I'm going to say T-bills. Think about adding silver and gold, which is what all fiat money returns to. It's money. The rest is currency. And this has been pushed down massively over the last month or so by people that have come together to sell the equivalent of the United States alleged gold holdings, about 8,000 metric tons, within the space of about 2 weeks after the election. You can imagine that that gold isn't there for them to offer anyone that has bought paper gold. There is no physical there. This is a huge manipulation of markets, just like bonds and stocks are so manipulated. Use this as a gift. Sell the things that have been manipulated up, stocks and bonds, and purchase the things that have been manipulated down. In this case, very much including precious metals, silver, and gold. Finally, consider investing in assets that are scarce and vital. Over the course of history, when any countries run into a bankrupt situation or a currency that loses any semblance of value, whether it's the Confederate Greybacks or a horde of currencies that have gone under, as I mentioned, fiat money has an average life expectancy of 27 years. The fiat dollar is 45 years old. What always happens in countries that get into disarray and have an impoverishment of masses is food and energy hold their value and become, at the margin, more valuable because people need those. They can't go without them. Those arenas, plus silver and gold in physical form, is where we suggest you put some of your funds to work from selling overvalued stocks and bonds. And don't forget to park your cash in safe places. This is quite a lot to chew on. Perhaps some of you will find it of note, of help, of reflective help. I will end this right here. This is Dan Kurz, DK Analytics. It is November 20th, 2016, and we may be on the brink of a major recalibration in values of stocks and bonds that can happen at any moment, but you have to act before it does. Use this central banking gift. Bye-bye.